Imagine this for a second. A seemingly quiet Wednesday, a central bank official steps up to a microphone, speaks just 12 words, and within minutes, poof, $300 billion vanishes from global markets.
Just like that?
Yeah, no war, no big scandal, just a sentence. And the moment it hit the airwaves, absolute panic. So today, we're doing a deep dive into exactly how those, seemingly innocent words from central banks can trigger these massive market shifts, and crucially, why understanding them is so important for you. Think of it like a shortcut to being really well-informed, packed with some surprising insights you probably won't hear elsewhere.
That's absolutely the truth. In the, let's say, high-stakes world of finance, language isn't just about communication. It's a precision instrument, a tool, maybe even a weapon sometimes.
A weapon, that's strong.
Well, think about it. Central banks, like the Federal Reserve here or the ECB in Europe, they've truly mastered this. Every single word you hear, meticulously chosen, strategically crafted. It's designed to guide, maybe to warn, or sometimes, yes, even to shock markets into action. It is never ad-libbed.
Right.
It's like a really sophisticated game of chess where all the pieces are made of words. And this whole idea of reading the tone or sentiment parsing, that's what moves trillions. Literally trillions.
Okay, so our mission today then is to decode that language, pull back the curtain a bit.
Exactly.
We want to help you understand why just a tiny shift in phrasing, like, say, going from moderate inflation risk to persistent inflation pressure, why that can trigger billions in trades within seconds, even if there's no actual policy change announced right then.
That's the key. The anticipation.
So you'll learn to recognize these signals, hopefully, so you're never completely caught off guard again. I mean, think back to the 2013 taper tantrum.
Oh, yeah, classic example.
A mere hint from the Fed, just a suggestion they might slow down bond buying, and bang, stock market tanks, bond yields spike, emerging markets just free fall.
Cost investors billions.
Billions! And most people had absolutely no idea why it was even happening. So this deep dive, think of it as your personal translator. We're giving you the code.
Good way to put it.
Okay, so let's unpack this. Let's use a prime example, something more recent. Picture June 15th, 2022. Look like any other Wednesday, right?
Right. Fed meeting day. Always important.
Fed Chair Jerome Powell steps up to the podium, post-meeting press conference, adjusts his notes, the room goes silent, cameras flashing everywhere, and then he delivers the key line. We're strongly committed to returning inflation to our 2% objective, and we will keep at it until the job is done. 17 words.
Said very calmly, too.
Exactly. Almost sounded boring if you weren't really listening for the subtext.
But, oh boy, the calm was totally deceptive, wasn't it? Within seconds, maybe minutes, the market just started to break violently.
Yeah, what happened?
The Dow dropped, 500 points in under 10 minutes? The NASDAQ just went into free fall. Bond yields surged. Mortgage rates spiked almost instantly. And the headlines just screamed, markets tumble after hawkish Fed tone. Hawkish, meaning the Fed sounded aggressive about raising rates.
Okay.
Others warned. Powell signals more pain ahead, or investors brace for recession. What actually happened there in that moment was those 17 words signaled something pretty devastating. It's like a firm declaration. The Fed was willing to cause real economic pain, job losses, slower growth to beat inflation. And Wall Street, they heard it loud and clear, translated it into action immediately.
So those 17 words, they sound simple enough on the surface. From your perspective, what was the actual hidden message, the subtext that Wall Street just grabbed onto so fast? How'd they dissect it?
It really boils down to parsing the intent behind each specific phrase. So when Powell said strongly committed, that wasn't just, casual talk.
Right.
It signaled unwavering resolve. It meant we're not backing down from this inflation fight, period. Okay.
Strong signal.
Then returning to our 2% objective. That pins down the target. Laser focused on inflation, almost no matter the economic cost. But the real kicker, the phrase that I think sent shivers down spines on trading floors, was until the job is done.
Open-ended.
Exactly. No timeline, no defined endpoint. That meant this pressure, these rate hikes, could last for months, maybe even years. uncertainty.
So the market isn't just reacting to the words themselves, but to what they think happens next, all based on that huddle language shift.
Precisely. Traders immediately started pricing in, basically adjusting their bets for an aggressive series of interest rate hikes. And at the exact same time, those super fast algorithms, they picked that critical shift in tone.
The bots.
They ran their predictive models and bam, dumped billions in equities, stocks, and that hits everything. Pension funds, tech portfolios, your 401k, all from one speech. Those 17 words.
And the worst part, you mentioned earlier.
Yeah, the worst part is most everyday investors, regular people, they had absolutely no idea what any of it really meant. They didn't know Powell's tone had hardened. They didn't get that until the job is done was being read as like a declaration of economic war on inflation. They just saw red in their retirement accounts and wondered, what on earth just happened?
That's an incredible story. 17 words reshaping markets like that. But it makes me wonder, what is it about words, this language, that gives it such immense power, sometimes even more than direct policy actions?
That's a great question. And it's fundamental, really, to how markets operate. The simple truth is markets are inherently forward-looking, always trying to guess the future.
Right, they trade on expectations.
Exactly. Yeah. They don't trade on what just happened 5 minutes ago. They trade on what people think will happen next month, next year. And in the global economy, who's the most powerful setter of those expectations?
The central bank.
The central bank's microphone, no doubt. When they speak, they are quite literally guiding the future, or at least trying to.
So it's less about the current economic numbers and more about the central bank's signal about what they plan to do because of those numbers.
Precisely. And that's where the dominoes really start to fall. Let's take another example. Say a central bank says something like, we expect inflation to remain elevated in the near term.
Okay, sounds pretty neutral, maybe even a bit obvious.
Seems harmless, right? But behind the scenes, the big institutional traders, the algorithms, they instantly interpret that as, okay, hold on. The central bank might raise interest rates again, maybe sooner than we thought. And that expectation alone makes borrowing money more expensive, which immediately hits growth stocks like tech, the hardest. Bond yields adjust instantly. Then the algos detect this slightly more hawkish tone leaning towards tighter money, and they just start selling automatically, lightning fast.
And panic spread.
Panic snowballs across trading desks. And just like that, trillions can shift, not because anyone actually did anything concrete yet, but just because of how the central bank framed the future.
It's almost like they're, like air traffic controllers for the economy, but instead of radar, their main tool is just language.
That's a perfect analogy.
Yeah.
They're trying to land the economy safely, avoid a crash, and their primary tool is that precise language. Phrases like, we're monitoring conditions closely, or we remain data dependent. They aren't just, polite filler.
No,
they're critical liquidity signals. A dovish tone suggesting easier money, maybe lower rates are coming, implies capital will flow freely. For stocks, usually. A hawkish tone suggesting tighter money, maybe rate hikes, pain ahead signals constraint, less money flowing. Markets aren't just listening for the facts in the speech. They're listening intently for the intent. What's the underlying message?
Okay, intent. That makes sense.
And here's where it gets really interesting, especially now. A huge, absolutely colossal chunk of daily trading is done by algorithms, bots.
Right, you mentioned the bots.
These things scan central bank statements the instant they're released, parsing the text for even the most subtle changes in wording and sentiment in intensity compared to the last statement. So if the Fed says inflation is easing today, but last month they said inflation is moderating, that tiny shift
seems minor.
To us, maybe, but that slight change in tone could trigger millions, maybe billions of dollars in trades in less than a second. These bots don't care about what's meant in a nuanced human way. They care about what's changed programmatically.
Wow.
And they trade faster than any human can possibly blink.
So it sounds like, humans are kind of outmatched by these things then. Is there any way for a regular investor to level the playing field at all, or are we just always reacting?
Well, that's the challenge, isn't it? But understanding how these bots and the big players interpret the language, that's your edge. Or part of it. Let's go back to Powell's phrase. We will keep at it until the job is done. If you're running a big pension fund or a hedge fund, that phrase instantly tells you several things. 1, rate hikes are likely going to continue. 2, there's no clear end in sight. 3, the Fed is signaling they're willing to tolerate economic discomfort, maybe even a recession, to hit their goal.
Okay, so what do you do?
So strategically, You shift to safer assets. Maybe you short some over-leveraged companies betting their stock price will fall because they have too much debt. You pull capital out of those rate-sensitive growth sectors.
Yeah.
And crucially, you do it fast.
Right. Before everyone else does.
Before everyone else does. This is the kind of profound emotional and obviously financial intensity that central bank language creates. And it's exactly why just a few words can and do move trillions.
And here's the kicker, as you said. Most everyday investors, maybe even you listening right now, completely miss this. It's a huge blind spot. People blame, I don't know, politics, or just say, oh, it's a bad economy, when really the trigger might have been a 2-word change in a press release they didn't even read.
Exactly. They don't teach this stuff in school.
Nope. But today, we're decoding it. Right here, we've actually compiled a list, the exact 12 words and phrases that, well, consistently seem to spark the biggest market reactions. They sound harmless, some of them, maybe even boring. But to Wall Street, they are absolute code, triggering massive moves, sometimes multi-billion-dollar losses. Ready?
Let's do it. Let's break them down one by one.
Yeah.
Because these are kind of your new keywords for understanding market reactions. Listen for these. Number 1, further tightening.
Okay, what's that mean?
It's a direct signal. These higher interest rates are still coming. Pretty straightforward. Expect pain for borrowers, a slowdown in credit markets, and usually a drag on those high-flying tech stocks.
Got it. Okay, number 2.
Higher for longer.
That sounds persistent.
It is. It unequivocally means don't expect relief anytime soon. Rate cuts. Off the table for quite a while. Investors hear this and often flee risky assets looking for safer places for their money.
All right. Number 3.
Persistent inflation.
Okay, that sounds bad.
It is for markets. The translation is, inflation isn't going away quickly or easily. When this phrase starts appearing in official language, it strongly signals the central bank is probably about to get even more aggressive with rate hikes. Spooks both stock and bond markets. Fast.
Okay. Number 4.
Stagflation.
Ooh, the nightmare word.
That's the one. The absolute nightmare scenario. Low economic growth plus high inflation. It means there are really no good policy options. If the central bank uses this word, markets tend to panic. Big time.
All right, avoid that one. Okay, 5.
Substantial risk remains.
Sounds vague.
It's intentionally vague.
Yeah.
But its real meaning is something like, we don't really trust this economic recovery yet. Significant problems, headwinds persist. That uncertainty alone is often enough to cause capital to just exit sensitive sectors almost overnight.
Okay, 6.
Reassessment needed.
Uh-oh, reassessment.
Yeah, I was right. This signals a potential change in the central bank's outlook or even their strategy. And markets, which absolutely thrive on predictability, they hate surprises. This signals a big surprise might be coming.
Gotcha.
Number 7, financial conditions loosening.
Wait, listening sounds good, right? Like things are getting easier.
Ironically, no. Not usually from the central bank's perspective. It often means markets are getting a bit too hot, maybe too much speculation or borrowing. Investor exuberance is too high. It's actually a subtle warning. It means the central bank might step in and act to cool things down. Think, hitting the emergency brakes.
Okay, tricky one. Number 8.
Remain vigilant.
Vigilant sounds watchful, calm almost.
Sounds calm, but it's not really. It means they are actively watching for signs of trouble, volatility, and they might act suddenly, maybe without much warning. It's a statement of readiness to intervene.
Okay, number 9.
Wage inflation.
Wages going up. Isn't that good for workers?
Good for workers in the short term, yes.
Yeah.
But it freaks markets out. It suggests rising labor costs are becoming sticky, becoming ingrained. That could force companies to shrink their profits, maybe cut jobs down the line, or pass those costs on to consumers as higher prices.
Which fuels more inflation. A vicious cycle.
Exactly. A wage price spiral fear.
Okay. 10.
Extended pause.
A pause, like they're just stopping rate hikes. That sounds okay.
A pause sounds relaxing, maybe, but not really in this context. It injects uncertainty. Investors suddenly don't know if the next move is another hike or maybe a cut way down the road. So what do?
Sell.
Often, yeah. They sell just to be safe, reduce risk, creates volatility.
All right. 11. Almost there.
Not yet at neutral.
Neutral. What's neutral?
Neutral is like the theoretical interest rate level that neither stimulates nor restricts the economy. So not yet at neutral is basically central bank speak for. We are not done raising rates yet.
More tightening coming.
Yep. Markets hear that and know it means more tightening, less liquidity sloshing around the financial system, and likely more economic pain ahead.
Okay. And the last one. Number 12.
Data dependent. And this might be the most deceptively dangerous phrase of them all.
Really? Data dependent sounds reasonable, flexible, like they'll react to the facts.
It sounds flexible, yes. But what it really means, especially to traders, is, honestly, anything can happen next. We don't even know for sure what our next move will be until we see the next inflation print or jobs report. That extreme uncertainty, that lack of a clear path forward, that alone is enough to move billions. Markets hate that kind of uncertainty.
Wow. That list is incredibly insightful. It really makes you rethink how you listen to financial news, doesn't it?
Absolutely.
Are there any on that list that even, professionals sometimes misinterpret, or ones that are just particularly tricky to decode right in the heat of the moment?
Well, it's less about outright misinterpretation, I think, and more about the sheer speed required to react. Like you said, data dependent is always tricky.
Yeah.
Because it basically puts everyone on edge, right?
Yeah.
It forces the market to react, sometimes overreact, to every single new economic report with just amplified intensity, waiting for the next clue. And financial conditions loosening, one often confuses newer investors because, like you said, it sounds good, but it's very often a precursor to the Fed actually tightening things up.
Right. Okay. So now that you, our listener, know these 12 trigger phrases, the real question is, okay, what do you do when you hear them? How do you go from just identifying the words to actually decoding the signals and, protecting your portfolio?
Right. The actionable part. Remember, central banks aren't really speaking plain English. They're speaking in signals. Codes. So, for instance, when a Fed chair says the committee remains data dependent, what they're really saying underneath is, look, we're uncertain about the path forward. And if that next jobs report or inflation number spooks us, we will act fast, maybe even between meetings.
Oh.
That little phrase, it gives traders their marching orders. It tells them, be on high alert for the next piece of economic data. It can change everything.
Okay, give us another translation.
Sure. Or when you hear financial conditions are becoming unbalanced. Again, that's not just an observation. It's code for, okay, markets are partying a bit too hard here. Asset prices might be bubbly, and we're getting ready to crash the punch bowl, probably by raising rates.
Way away the punch bowl. Got it.
And something like, the path forward remains uncertain. Sounds kind of bland, right? But smart money, experienced investors, they immediately hear, okay, brace for turbulence, expect volatility, don't make any big risky bets right now.
So it's not just what they say in one speech, but watching the subtle changes in how they say it over time, that seems critical.
Absolutely critical. Pay extremely close attention to those subtle word changes from statement to statement, month to month. If a central banker, for example, drops using the word transitory, meaning temporary, when talking about inflation, and replaces it with a word like entrenched or persistent.
Big difference.
Huge difference. That signals a massive fundamental policy pivot is likely underway. The algorithms spot those changes instantly, and markets often move significantly before the traditional news media even catches on to the shift in language.
So what can you actually do with all this? How do you put it into practice?
Okay, practical steps. First, start listening to central bank press conferences, or at least reading the summaries or statements, like you'd analyze body language or read between the lines. Pay intense attention to what changes. Ask yourself, what specific word was dropped from last time? What new word was added? What phrase was said with maybe more emphasis or a noticeable tone of caution than before?
Okay, listen for the changes.
Second, diligently track the market reaction immediately after these statements or speeches. When you see a particular phrase cause a big knee-jerk market move, log it, even just mentally. They said persistent inflation and bonds sold off. Over time, you'll build your own internal decoder ring.
Makes sense. Learn from experience.
And third, and this is really critical, don't wait for the mainstream news headlines. By the time it's on CNN or in the Wall Street Journal hours later, the smart money, the algos, the really well-informed folks, they've already made their moves, maybe hours ago. You need to be paying attention sooner.
This is where it really becomes empowering for you, the listener. Because, like you said, it's often too late to prepare once those microphones are actually on.
Exactly.
The game isn't really won during the speech. It's won before it even starts, by being prepared. So how do you proactively protect yourself, protect your investments?
Okay, here's some concrete proactive steps you can actually take. 1, know the calendar. Simple, but crucial. Central banks never speak by surprise. Not really. Their meeting dates, their press conferences, the times they release statements, it's all published months in advance.
Right. It's public info.
Totally public. Circle those dates on your calendar. Set alerts on your phone. Treat Fed days or ECB days like incoming weather fronts. You know they're coming, so prepare.
Okay. Good first step. What's next?
2, trim exposure beforehand. If you're sitting on, say, some nice short-term gains, especially in volatile assets, think high-growth tech stocks, speculative names, what traders call high beta plays because they swing wildly. If you hold those heading into a big central bank press conference, just ask yourself honestly, would I be okay watching this position drop 10%, maybe 15% in an hour if the tone is surprisingly hawkish?
Good question to ask.
If the answer is no, that would freak me out, then maybe consider scaling back your exposure before the event. Trim the position a bit. It's called de-risking into event volatility, just reducing your bet size before potential fireworks.
Okay, de-risk. Got it. 3.
3. Use price alerts, not just stop losses. Market moves after these events can be incredibly fast and violent. Traditional stop losses. Sometimes they can get you whipsawed, sold out at a bad price on a quick dip, only to watch it recover immediately after.
Right, that's frustrating.
Very. So instead of relying only on automatic stop losses, consider using price alerts. Set alerts at critical technical levels for your holdings. If the price hits that level after the Fed speaks, you get notified, and then you could look at the situation and make an informed decision, not just an automatic, potentially emotional reaction.
More control. Okay.
4. Diversify away from panic-prone assets. We mentioned tech stocks, and speculative plays often get crushed during hawkish surprises. So diversify your portfolio. Assets like bonds, maybe some gold, even just holding a bit more cash, these can act as shock absorbers. Your portfolio needs both offense, growth assets, and defense, safer assets. If you only hold offense, you're basically just gambling on the Fed's mood.
Offense and defense, like a sports team.
Exactly like that. Balance is key. 5. Follow the yield curve.
The yield curve. Sounds complicated.
It's not sexy, I admit, but it's remarkably predictive. It just shows the difference in interest rates between short-term bonds, like the 2-year Treasury, and long-term bonds, like the 10-year. It's a snapshot of market expectations. When central banks speak, these bond yields move immediately. So watch how the 2-year and 10-year yields react right after a speech. That's often your earliest warning system.
What does it tell you?
Generally, a flattening curve, meaning the gap between short and long rates narrows signals rising fears about future economic growth. A steepening curve, the gap widening, often signals rising inflation fears. It gives you a quick read on the market's gut reaction.
Okay, watch the yields. And finally,
number 6, and maybe the most important, but the one almost nobody talks about. Zoom out. Remember the big picture. Most of the immediate panic and reaction we're talking about. It's often short-term noise. If you have a clear long-term financial plan, if you own quality investments for the long haul, and if you're not dangerously over-leveraged with borrowed money, then a few scary words from a central banker, even if they cause a temporary 5 or 10% dip in the market, they really shouldn't derail your entire financial future. Patience is a powerful and seriously undervalued asset in investing.
That's a great reminder. Zoom out. Okay, so this skill, decoding this language, it isn't just for the big hedge funds or the Wall Street pros and skyscrapers.
Not at all.
It's really for you, the everyday investor who's maybe tired of getting blindsided by all this market chaos. It's about understanding the language behind the chaos, so you can stop feeling like a victim of these market swings and instead maybe become someone who sees the potential for swings before they even happen.
Exactly right. Imagine that. Imagine hearing a central bank speech, immediately understanding what those 12 specific words or phrases really mean in context, and being able to make informed decisions, even if that decision is just to stay calm and do nothing, but doing it before billions and billions of dollars start flooding out of or into certain parts of the market. That's real power. And it's not magic. It's definitely not insider trading. It's just knowledge wrapped in some patience, a bit of strategy, and just awareness. Master these words. Watch how markets react over time. Learn when to maybe take some action, and just as importantly, learn when to stay calm, zoom out. Suddenly, the next market panic. It doesn't have to feel like a trap. It might even feel like an opportunity.
So, a final thought for you to take away. The next time you hear a central banker speak or read their statement, really think about the subtle, immense power packed into their words. Consider how understanding these signals, this code, can shift your own perspective, moving you away from fear maybe towards more informed decision-making, not just in your investments actually, but in how you understand the whole broader economic landscape that influences our everyday lives. This deep dive hopefully has armed you with the code. The question now is, what will you choose to do with it?